I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risk of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you we will not stop at this. We'll do whatever is needed. On top of all of it, let's also take a look at a moment to put the situation in a broader context. We've made strong economic progress in the past 2 years. We've created more than 12 million new jobs, more jobs in 2 years than any president has ever created in a single 4-year term. Unemployment is below 4% for 14 straight months. Take-home pay for workers is going up, especially for lower and middle-income workers. And we've seen record numbers of people apply to start new businesses, more than 10 million of them, more than 10 million applications over the last 2 years starting businesses. Now we need to keep this progress going. That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
Do you expect other banks to fail, Mr. President?
Should all depositors be protected at all banks?
That was President Biden assuring the American public that, in his words, our banking system is safe after the collapse of 2 banks in 3 days. The president says that depositors at those banks, Silicon Valley Bank and Signature Bank, will be able to access their money and will be made whole. I want to bring in ABC's chief business correspondent Rebecca Jarvis and senior White House correspondent Mary Bruce for more on this. Mary, the president is insisting that this isn't a bailout. So walk us through this. How is this working?
Yeah, the president there is trying first and foremost to assure Americans that the situation is under control. And as you said, he wants to make sure that Americans understand and feel confident that they can trust the American banking system and that they can trust that their deposits are there, that their money will be there when they need it. And he is underscoring this point that he says this is not a bailout, that this is not a repeat of 2008. You heard him say there clearly that the banks are paying for this, that this is not coming out of American taxpayers' money. And he's underscoring this point that those who are responsible will be held accountable, that they will face consequences for this, but the depositors, those who kept their money with these financial institutions, shouldn't be the ones who are bearing the consequences of this. But again, the president just trying to assure Americans that they can feel safe in the banking system and trying to prevent any sense of panic here and assure Americans that there won't be a ripple effect throughout other financial institutions. Diane.
Now, Rebecca, while the president is promising to hold those responsible accountable, he's also saying they need to look into this a little further to figure out how this all happened. What do we know so far?
Well, Diane, what we know is really what happened over the last decade, and that is that a number of companies got 0% interest rates, expanded, especially in the tech space, especially in the crypto space, and those are the banks that we have now recently seen fail. Those companies failed, and many of those companies had issues. That led to these banks, at least over the last decade, getting very big, much bigger than they were. And as a result of what's happened with interest rates now going up, that's made business much harder on these banks. They've had to sell assets as a result of that, and in turn, customers have gotten very concerned about their financial position and gone in and done a run on the bank, which is what we saw with SVB over last week, where customers pulled out $42 billion. The question going forward is what new reforms go in place. The administration doesn't want to call this a bailout, and it makes sense why. I was here in 2008 when a number of banks got bailed out. That was highly unpopular. People not far from here sat in Zuccotti Park and wanted to abolish the Fed. They wanted to see an entirely different universe. That's not really where we are today, but we are dealing with a situation that is very different than those bailouts of 2008, because in this case, what the government is doing here is they are saying every depositor, no matter what bank you bank with, whether it's small or large, you will get your money back if that bank goes out of business. And the people who own stocks in those banks, who had debt in those banks, they, in the natural course of things, will lose their money because they took on that risk, knowing that there was a risk they could lose it. Again, depositors are made whole, but the people who invested in these companies will lose their money as they would in any other kind of bankruptcy. Diane?
So, Rebecca, what are the biggest concerns now, and what might these future regulations look like?
Well, the concern right now is the contagion factor, and that's really what the government had tried to do over the weekend. The goal, the hope, was that someone might come in and buy SVB, that a private bank would come in and buy SVB. That did happen in the UK. The SVB UK assets were bought for £1 by HSBC Bank overseas. The issue is that the U.S. could not secure a buyer for SVB or Signature Bank. Now the FDIC has taken over both of those banks, and they'll go through the process starting today with people who have funds in them, depositors, being able to take that money out. The question going forward is whether or not smaller banks will be held to a higher regulatory standard. The big banks coming out of the financial crisis did see their standard, their burden of operation go up. If that's the case with smaller banks, it could mean some of those incentives, the higher yielding savings accounts that people appreciate from smaller banks, are less available because they increase their standards, in turn increasing their costs, and then a customer sees a little bit of less payment on their account. But of course, we all want our money to be safe when it goes into the bank, Diane.
All right, Rebecca Jarvis, Mary Bruce, thank you both. And our coverage continues on ABC News Live and abcnews.com. David Muir will be back with the entire team for World News Tonight. I'm Diane Macedo in New York. Have a good day.
This has been a special report from ABC News.
Good morning, I'm Diane Macedo. We are continuing our coverage after President Biden just spoke, assuring the American public that our banking system is safe. This comes after the collapse of 2 banks over the course of 3 days. I want to bring in our senior White House correspondent, Mary Bruce, for more on this, along with our chief business correspondent, Rebecca Jarvis, and our business reporter, Alexis Christoforous. Mary, walk us through the timing here. The government in general and the Biden administration clearly thought this was something they needed to get ahead of. Why the rush?
They moved very quickly here. I think obviously they were very concerned about how the markets were going to respond this morning. I think there obviously was a very noted shift in tone after we saw the bank fail on Friday. The White House trying to assure everyone then that we wouldn't see a ripple effect, that there were systems in place to prevent that. But clearly over the weekend, they became concerned that you would see a rush on the bank in other areas of the economy, and they were concerned that they had to do something. This was a very big step, and the president there is trying to send that very clear and strong message to Americans that they can trust the financial system, trust the banks, and that their money will be there if and when they want to go and pull it out. That is the basic core here of the message that the president is sending. But he is also well aware of the political risk here for him, that this move will be seen as very unpopular by some. We've already seen a lot of pushback, which is why the president is trying to come out this morning and make that case that this is not a bailout, arguing that American taxpayers, he's stressing, are not at risk here, that this is being funded by the banks, not the taxpayers, because he knows that he's going to face some pushback from this. And everyone remembers 2008, but he's saying this is not that. This is a different situation, and reiterating that those who are responsible for this will be held accountable. You heard him there say, look, they're going to be fired, they're going to be losing their money, but that the depositors, those who bank at these institutions, should not be bearing the brunt of other people's mistakes.
Now, Rebecca, you mentioned contagion is a huge concern now, because bank runs are one of those things that can feed on themselves. If people think there might be a bank run, they're more inclined to pull their money out, which causes a run on the banks. What do we know, though, about how this all started? SVB was low on capital. Do we know why?
Well, Diane, it really goes back to what's happened over the last handful of years. During the pandemic, a number of tech companies made more money. A number of startups made more money. They put that money into SVB. SVB then turned around and invested those funds into what was perceived as very low risk at the time, treasuries and mortgage-backed securities. But that was when interest rates were low. They were rock bottom, 0%. As interest rates started to go up, those securities started to lose their value, and SVB was forced to start selling in order to cover some of the losses. In turn, when they put out a notice on Wednesday to their customers and to the markets that they would be raising new capital in order to cover the shortfall, the market got spooked. And a number of venture capitalists who advise the founders of these tech companies as well as the startups went to their founders and said, pull your money from this bank. We don't know if it's going to be safe. That's exactly what they did. Diane?
So, Alexis, given the tie into interest rates here, what could this mean for the Federal Reserve's next move?
I think what we're seeing are unintended consequences of a string of rate hikes from the Federal Reserve. And now we're seeing traders in both the U.S. and the U.K. betting, if you look at the markets, they're betting that the Fed may actually start cutting interest rates as early as June to try to loosen things up a little bit. I mean, one of the big problems with SVB is, yes, a bunch of tech startup investors wanted to get their money out at once, but also the bank took a lot of that money they made during the 2021-22 time period, and they went out and they bought bonds at a time when interest rates were low. When interest rates started to rise and the bank had to sell those bonds in order to pay back the depositors, the value of those bonds had fallen. So again, an unintended consequence of higher interest rates, and I think the Fed's going to have to take a good hard look at how much more aggressive they want to get with these higher interest rates. We know they're trying to fight inflation, but there are all these other areas that it's seeping into the economy and wreaking havoc, frankly.
It certainly looks that way. Alexis, Mary, Rebecca, thank you all. And we'll be right back with some of the day's other top stories. Stay with us.